What if the smartest way to build passive income was to do almost nothing at all? It sounds counterintuitive, but research consistently shows that the majority of active fund managers, over 80% to 90% in some long-term studies, fail to beat the market. That's why index funds, which simply track broad market indexes like the S&P 500, represent the ultimate lazy investor strategy. For most people, quietly buying and holding these funds works far better than actively trying to pick winners, and the data overwhelmingly backs this up. An index fund is a beautifully simple concept. Instead of betting on a single company or a handful of stocks, it buys all the companies in a specific market index. An S&P 500 index fund, for example, gives you ownership in the 500 largest US companies. A total stock market fund goes even further, owning thousands of companies of all sizes. This approach provides instant diversification, spreading your risk so that the failure of any single company won't sink your portfolio. More importantly, it allows you to capture the growth of the entire economy. Over long periods, the US stock market has delivered powerful returns, with the S&P 500's historical average often cited at around 10% annually. There are two critical facts to understand here. First, as studies from S&P Dow Jones indices repeatedly show, most professional money managers who actively pick stocks fail to outperform their benchmark index, especially after their fees are factored in. This makes a strong case for not paying extra for underperformance. Second, individual investors often do even worse than the funds they invest in. The reason? Behavior. According to Dalbar's long-running research, investors tend to buy high during market euphoria and sell low during market panics, a cycle of emotional decisions that severely damages their long-term returns. Indexing helps you sidestep both of these pitfalls. Let's look at the numbers to see how powerful this lazy approach can be. Imagine you set up an automatic investment of $500 every month into a low-cost S&P 500 index fund. Using a conservative average annual return of 8%, which is below the long-term historical average, the results are staggering. A common question for new index investors is whether to choose an S&P 500 fund or a total stock market fund. The S&P 500 gives you exposure to the 500 largest, most established companies in the US, which form the backbone of the economy. It's a fantastic core holding. A total stock market fund, however, includes those 500 companies plus thousands of additional small and mid-cap stocks. This provides even broader diversification and captures the growth potential of smaller, more nimble companies that might one day become the giants of tomorrow. For most investors, the difference in long-term performance between the two is often minor. Either choice is excellent. The most important decision isn't which one to pick, but to simply pick one, stick with it, and keep investing. The true edge of the lazy investor lies in three things: avoiding market timing, maintaining discipline, and, crucially, minimizing costs. The data from Vanguard and others is clear. Fees are a primary determinant of long-term investment success. Active funds often charge expense ratios of 1% or more, which may not sound like much but acts as a massive drag on your returns over decades. In contrast, broad market index funds from major providers can have expense ratios as low as 0.03% or even less. That tiny difference means tens or even hundreds of thousands of dollars more in your pocket over an investing lifetime. The lazy strategy is simple. Set up automatic monthly contributions into your chosen index fund, rebalance your portfolio once a year, and then get on with your life. You ignore the daily news, the market forecasts, and the stock tips from your cousin. You just let the system work. To put this into practice, there are a few important points to remember. First, always prioritize low fees. Look for index funds or ETFs with expense ratios well below 0.2%. Over 30 or 40 years, even a small difference in fees compounds into a significant amount of lost growth. Second, be mindful of taxes. For investments held outside of retirement accounts, ETFs are generally more tax efficient than traditional mutual funds. Whenever possible, maximize your contributions to tax-advantaged accounts like a 401k or an IRA first. Third, your asset allocation matters. A simple portfolio isn't just about stocks. It's about balancing stocks and bonds to match your risk tolerance and time horizon. A younger investor might be comfortable with a 90% stock and 10% bond allocation, while someone nearing retirement might shift to a more conservative 60-40 split. Fourth, rebalance annually. If your stocks have a great year and now make up a larger percentage of your portfolio than you intended, sell some and buy more bonds to get back to your target allocation. This forces you to systematically sell high and buy low. Finally, remember that your behavior is more important than your skill. Automating your contributions removes the temptation to make emotional decisions, which, as Dalbar's research confirms, is the single biggest cause of investor underperformance. This isn't just a niche theory. It's a strategy backed by overwhelming evidence and endorsed by the most respected figures in finance. Year after year, the Spiva reports confirm the underperformance of active managers. Behavioral studies from Dalbar quantify the cost of emotional investing. And perhaps most famously, legendary investor Warren Buffett has consistently stated that a low-cost S&P 500 index fund is the best investment most people can make. The proof is all around us. For the vast majority of investors, a simple, low-cost, passive approach is not just easier, it's more effective. So if you're looking for a path to passive income that grows predictably over decades, index funds are the laziest and one of the smartest strategies available. The key is to start small, automate your investments, keep your costs rock bottom, and let the incredible power of compounding do all the heavy lifting for you. Are you Team S&P 500 or Team Total Market? Let me know your choice in the comments below, and don't forget to subscribe for more practical investing guidance. No hype, just strategies that actually work.